Uh, I'm joined today by my colleague Mark Swallow. How are you this morning, Mark?
I'm very good, thank you, David. The sun shining on me today, so feel very privileged.
Yeah, got the sun here as well. Actually, you're quite far west, aren't you? And I'm quite far east. So
yeah, exactly. Yeah, we couldn't be any further apart, but that's nothing personal, David. It's just geography.
So we've got a consultation, two consultations, Mark. What's this all about?
Yeah, well, CIPFA have decided to issue consultation on the Prudential Code, probably as a result of recent changes to the PWB lending arrangements and the sort of commercialisation agenda that's been occurring. And on the back of that, they've also decided to consult on the some minor changes to the Treasury Management Code.
Yeah. What's because we had new codes in 2018, didn't we? So they weren't good enough.
Well, exactly. We were saying, I think on my recent insight I published around sort of the historic capital control system, I think we calculated this is the 6th variant or mutation using current slang of the code since 2004, since it's introduced. And I think the main reason why the changes have sort of come through is because of there's been quite a lot of activity, hasn't there, since 2015, particularly, where local authorities borrowing money as the Treasury, as the government, and as CIPFA define investing for yield or investing in advance of need. So I think that's the reason why the changes have come in, because local authorities have been borrowing cheap, buying assets to generate return, and there's a concern that they've exposed themselves to some big risks, and I think the idea is to try and align the Prudential Code and the PWB lending arrangements to try and prevent local authorities from doing that in the future.
Yeah, I think that's very clearly CIPFA's and government's wish. They just don't seem to be going about it in a particularly clear way.
No.
It's my worry on this, really.
Yes, there's just some minor changes, isn't there? I don't know if you've got sort of an idea of what the main changes are, but really the main change in terms of, well, the sort of the basis of the code is that local authorities, it used to say in the code that local authorities must not borrow more than or in advance and it's of their need purely in order to profit. They've changed they made a minor change and changed the word purely to primarily. So you can borrow to profit from the investment, but not purely. So that if it's a byproduct of your investment profit, then that's okay. So again, that links nicely with the changes to the PWB lending arrangements, where they allow you to borrow to fund regeneration. Borrowing purely to buy an asset to generate yield, looks like it's off limits. But borrowing to invest in your local area and where yield is a byproduct appears to be okay, and I believe that the Prudential Code is actually adding an additional paragraph. I think this is paragraph 45. Is this change? I think there's a new paragraph that's suggesting that they insert, which actually covers regeneration specifically. So you'll still be able to borrow to regenerate your local area, but I think it's clear that they don't want you to borrow to invest just to make profit.
Yeah, I guess my problem this always has been this statement: local authorities must not borrow more than or in advance of their needs. And yet, for many people, I mean, the only definition of need in the Prudential Code is the underlying need to borrow the capital finance requirement. Obviously, exactly, if you buy an investment property, that increases your CFR, so it increases your ability to borrow according to the code. But CIPFA's always been very clear that's not the case.
Yes, absolutely. This is where it's confusing, isn't it? Because why don't they just come out and say local authorities cannot borrow to fund the purchase of assets that are only going to generate profit? Put it in a clear way. This is open to interpretation, as it always has been, and it will continue to be interpreted by local authorities that wish to continue, I believe, investing in yield generating assets. It's interesting when you compare the code, the CIPFA code, and the investment guidance from back in 2018. In that investment guidance, that was changed, wasn't it, to cover, to bring investments in property in line with investments that we're more used to looking at, i.e. banks and etc. And it sort of defines in advance of need there again, but that still says purely, that guidance still says purely to or to profit, but it also says that if you disregard the Prudential Code, you can still invest in those type of assets. That's how that code is interpreted in my view. And so, you know, the Prudential Code says one thing, the investment guidance says another, and the investment guidance says that if you depart from the Prudential Code, you can do so providing you provide everybody with clear details of the risks and rewards of undertaking that investment. So it's, again, you know, I think there's still enough gaps in this to allow local authorities to continue to do what they've been doing pre these potential changes coming through.
Yeah, I think it will be important to define need. What is the need to borrow, and therefore when are you borrowing more than or in advance of your need? I think, you know, that's what they need to really button down. And because they've also got these lines, they're introducing things like commercial investment should be proportionate to your budgets. And so you can undertake commercial investment then. So there's obviously, I think they need to find what can't be done, what is being banned, what is still permitted as long as it's proportionate, and what is always permissible. You know, presumably making bank deposits is always permitted. That doesn't count in any of this, I guess.
No.
You know,
but again, I think
management investments.
I think this has been written, hasn't it? Just because there have been examples of local authorities that maybe you can accuse of their borrowing hasn't been proportionate. You know, if you've got a small district council that's got a net revenue budget of say 25 million and it's got an investment property portfolio of £1 billion, and that investment portfolio has gone from 0 to £1 billion in a fairly short period, then I think, yeah, you can probably understand this. You know, the importance of proportionate, but obviously the need for the income has been assessed by that local authority, and they've had to take that action to allow them to function because they've needed that additional income because grants been cut, and that's been the argument, hasn't it, by local authorities why they've, you know, the local authorities aren't in the game of being purely profit. They're not profit motivated, are they? They are trying to generate income so they can provide services to their residents, keep council tax at low levels, maintain reserves and balances, and so therefore they've been using their, you know, at the end of the day, again, going back historically, when local authorities were constrained about how much they could borrow, the Prudential Code was seen as a release, wasn't it? It's freedom to borrow for any purpose, as the 2003 Act states. And so they, you know, and there wasn't much activity up until around 2015, and then there's been an increase in borrowing to generate returns, and now CIPFA have decided that they, you know, and I think CIPFA have been pressured by central government and Treasury to try and get local authorities to rein in their borrowing personally. So it's interesting to see how this has evolved over time, but it's a bit late because lots of local authorities have done probably as much as they need to do, but it's also very topical, isn't it? Yeah.
I think your point about, you know, investments filling up the budget gap, you know, this line for CIPFA that commercial investment should be proportionate to the revenue budget, it could even sort of promote that, couldn't it?
Yeah.
My revenue budget has got a funding gap of 20 million, so I'm going to invest that at 5%, therefore I need 100 million of investment property to fill it.
Absolutely.
Yeah. They obviously don't mean that at all. It's almost the opposite of what it's been.
Yeah.
It'd be helpful if they could.
And that links into the next one, doesn't it? That capital expenditure should be sustainable in accordance with the corporate objectives of the authority. Well, you know, if the corporate objectives of the authority are to maintain services at a standard that they wish to continue pre sort of austerity or pre reduction in grants, then surely if that's an objective of the authority, then they need to generate income from other sources, and they've seen the ability to borrow at low rates and buy assets that generate returns as a way of doing that. So many local authorities have corporate objectives, and some of those corporate objectives are linked to increasing their commercial property holdings.
Yeah. They're also on about sustainability, meaning climate change rather than sustainable as in affordable over the long term. So it's a bit of a mix of a terminology here, I think.
Exactly. It's not clear, is it?
No.
But it's interesting to see that, even today, when I took my emails on this morning, there was a public finance piece around, Reading Borough Council have decided to put the brakes on their commercial property plans, so they've had to completely realign their capital programme, and I guess they've had to rewrite their revenue budgets if they're going to stop investing. But they have got an £80 million commercial property portfolio anyway, and that's probably historic, and maybe some additions over the last 5 or 6 years, but they have clearly said that they're not going to continue. But others, I think it was Leicestershire County Council, wasn't it, the other day, so they're going to continue that commercial property acquisitions because they realise they need to continue generating the income. So, I don't think this is going to be the end of commercial property activity throughout the sector, but it's going to make things slightly, more difficult, perhaps.
Sure. Okay. I guess that's a bit of a chat about the what's necessary. There's some more sort of details, suggestions in the consultation. So about change to the prudential indicators, and one is about using the liability benchmark. This is something we've pushed with our clients for many years. So I think it'd be good to see it get more of a statutory footing.
Absolutely, yeah. Like as you said, we've been doing liability benchmarks for, I think since 2012 that CIPFA produced a document around treasury management where they sort of introduced the concept of the liability benchmark, and we sort of picked up on that and thought it was a good idea, and it's in every single pack that we prepare for strategy meetings. We undertake the liability benchmark, don't we? And we're strong supporters of it. We believe that you can't make long-term borrowing decisions without understanding the shape of that curve, and it's good to see that CIPFA have decided to include it in the code, like 9 years after coming out with the idea. So it's good that they actually finally respond to what they believe is a good idea and bring it into their code. So yeah, all good on that one. Thumbs up. Yeah,
agree. I suppose as suggesting it replaces the current indicator, which is where you compare your gross debt to the CFR. Obviously, the liability benchmark will have your gross debt and your CFR, or I guess it'll have the loans. It will exclude your PFI and finance leases from both debt and CFR. So it'll be a gross loans and loans CFR, which is probably a pretty similar comparison. My only thought here was that the prudential indicator is actually the only bit that says that debt should not exceed the CFR, except in the short term. Which I think is obviously a key control, isn't it? CFR should be the maximum level of debt, or at least your maximum forecast CFR in the next 3 years should be your maximum level of debt. And the danger is they take that away by just letting you compare the two without putting a limit on them.
Yeah.
So I think that'll be a key point. And then we've got two of the indicators that were in the sort of recommended in the MHCLG guidance, or sort of, I think they're in the informal commentary to the MHCLG guidance. External debt and income from commercial investments. Now MHCLG would divide that by net service expenditure. CIPFA's gone for net revenue stream, which is something they already use for another indicator. I just wonder if that might be confusing to have similar but different indicators.
Yeah, I was going to, that was my view. I sort of I looked at the code, I looked at the 2008 guidance, and I recalled that there were these indicators that the CLG guidance recommended that local authorities produce, and that was where I was getting confused. Net revenue stream or service expenditure. It's why can't they have the same definition and the same way of calculating them, and then why can't they? Does it mean for those local authorities that have decided to prepare those indicators that the investment guidance suggested, but they weren't mandatory, they were suggested. Do they still continue to produce those and do another indicator for the Prudential Code, or do they scrap the investment guidance indicators, and just it's confusing. Why can't the two documents have the same indicator in there rather than different terminology? Because again, it's the borrowing advance of need, etc. It's just different definitions in documents that cover the same thing effectively.
Yeah, I mean, I guess maybe that's inevitable, having two separate regulators, but it's not helpful.
No, it's not. No, they're trying to get the same, achieve the same objective, aren't they? They're trying to stop local authorities borrowing money to invest in profit-generating assets. So make it easy for people to. I guess it gives us something to do, to try and compare the two and come up with a consolidated view. But it makes people preparing the prudential indicators and the capital strategies and the investment strategies, etc., makes their job even more difficult than it already is. So it's just annoying that CIPFA couldn't have sat down and thought about this in a bit more detail.
Yeah, I think so. So the external debt to net revenue stream, I guess that's clearly a sort of proportionality indicator, isn't it? And more debt is bad, if you like. I'm not so sure on the other one. Is having lots of income a good thing or a bad thing?
Yeah.
Okay, you're not meant to be comparing between authorities, but I think the idea of generally prudential indicators is you compare how things are moving from year to year. If your income from commercial activities is going up as a proportion of net revenue stream against service expenditure, I'm not sure whether that shows a good or a bad thing. And
you exclude any commercial income that you receive from fees and charges, don't you? So
yeah,
car park income, for instance, you take out of this, even though that's a commercial income stream. So again, it's purely focusing on income you've received from assets you've borrowed to fund.
Yeah, but parking's good, isn't it? Because people renting a parking space, aren't they? Isn't that sort of rental income almost?
Yeah.
What about if you let your car park to an operator, then lets it to people to park? At what point does it become an investment income? At what point is it just commercial fees?
That's right. Again, it's open to interpretation, isn't it? And every local authority is going to treat it potentially differently, and that's always been in the case since 2004. There's been different local authorities have treated some of these calculations different ways. I know that, as it did say at the outset of the Prudential Code, it wasn't a way of comparing local authority to local authority, but you'd expect some consistency in the way that indicators are calculated.
Yeah. Because of course a lot of the prudential indicators are meant to be derived from the statement of accounts, aren't they? So they're sort of trying to use consistent definitions of what debt is, like actually net revenue streams, taxation, non-specific grants. I guess the problem is that in accounting terms, a property is only an investment if it's purely for financial purposes, so for the yield or capital growth. Whereas here we're talking about assets primarily, so you'll be having the investment income from those in with service income instead of in with investment income in your accounts. So it's been dragging out the bits of service income that relate to investments according to this definition.
Yeah. So if you have an office block and you've decided to rent one of the floors because you don't need that any longer, and you rent that out on the commercial terms, then is that primarily or purely, it's where do you include that income?
Yeah. Well, I guess even worse if it's got 4 floors and you only occupy one.
Yeah,
so it is primarily for yield.
Yeah, absolutely. Yeah, I didn't think of it like that. So, and there you go. So it's a strange bit of terminology.
Okay, should we move on to the Treasury Management Code?
Yeah, absolutely.
Yeah. So CIPFA's got this idea that local government treasury management's become more complex recently, and they seem to be blaming MiFID II for this for some reason, which I think is a mistake. They're clearly keen that people doing treasury at local authorities, the treasury manager, line managers, the director of finance, and then councillors to approve it. All these people have the right knowledge and skills to do the job, which I think is obviously fair. But they're basically printing job specs, aren't they, for these portfolio staff, which I think is maybe a bit dangerous.
It is, yeah, and it's, you know, how many local authorities are there that, you know, it's a broad brush approach, isn't it? There are local authorities out there where treasury is such a big part of the day-to-day running of the organisation, and they've got a full-time treasury manager, and fair enough, that would have a job description and person spec and roles and responsibilities. But small district council where treasury management is just a job that someone does first thing in the morning, last thing at night, and spends a bit of time in the month preparing the various cash flow forecasts, etc. Do they need another job description attached to their main job description? It seems a bit over the top just to apply this. And like you say, MiFID 2 has been used as the reason for doing so, but haven't all local authorities, most of them, well, majority of them, opted up to demonstrate they're professional and have been, you know, been accepted as being professional clients. So surely that's enough, isn't it?
Yeah, I mean, over 90% of our clients that aren't in close have opted up to be professional client with us. Presumably they've done that with other financial services providers as well. But they're certainly not all complex treasury, are they?
No.
I mean, often, you know, we're quite happy to advise people don't borrow money, and therefore you don't have money to invest. You know, you can have quite a simple treasury and be low risk, but still want to be a professional client to get access to the cheapest level of fees and services. So, and it's the same with having if you are a professional client, to have a specific treasury management committee. You know, so your finance committee or your audit committee can't look at treasury management. You've got to have a constituted treasury management committee.
I think I can see that going down well with the committee departments in local authorities and members having to have another set of committees. Like you say, most of our clients, in my experience, it's the audit committee, isn't it, that do a lot of the treasury management side of things. And they just, you know, it's why do you have to set up an additional committee just to consider treasury management? It's again another level of bureaucracy that's not needed, I don't think. And it's again using MiFID 2 as the excuse for bringing it in. So I'm not really a supporter of that potential change.
No, I mean, it's obviously right for some authorities, and I think most of those already have a treasury management panel or something involving officers and members. So we're not against them. It's probably against it being mandatory.
Exactly. Yeah.
Okay, ESG, something else. I felt they're almost promoting ESG risk management to the same as credit risk management. So you should have a policy on who you will lend to and what your counterparty limits will be, depending on ESG risk, reporting breaches of it to full council as a matter of urgency. Yeah,
that's my interpretation of it as well. And is that the basis of the Treasury Management Code? Is that what it's all about? I thought it's about managing, you know, the risks in the Treasury Management Code Treasury Management are quite clearly laid out, aren't they? Security, liquidity, yield, effectively, are the risks you're trying to manage using the code. And is ESG, you know, is it just CIPFA jumping on a topical bandwagon? You know, we recognise the importance of ESG, don't we? We realise that members are quite. It's a strong message that we keep getting asked, don't we? You know, what's our ESG criteria of our investment portfolio? But it's not as easy to make treasury management decisions that you're hoping that you get the money back from the counterparty at the time you want it back. You don't want to then necessarily be considering if they are, you know, that money is being used in an ESG way, and it might be difficult to do so.
Yeah, I think we need to recognise that often sort of ESG branded investments can be higher risk, they can be lower yielding. It's a new developing area.
Exactly.
I mean, we do offer a service to clients. We did this last year and we'll be running it again in 2021 to help bring ESG ideas and theories into your treasury management strategies. It is a developing area. I think my personal view would be it's probably a little bit early for it to be mandatory. and obviously lots of different people have different views on what is ethical, what the right levels of ESG compliance are. So, yeah. You're definitely right. It's definitely a growing area. I guess the question is whether it's the right time for it to be a mandatory consideration.
I agree with that.
Okay, we've got a few questions. One on ESG. Well, it's more a comment really. Tim at Oxfordshire saying if CIPFA wants us to report on ESG, they should issue some proper guidance on it and not just pass the buck. I did notice that in the proposed text, I think in Tier P1 risk management, they give a description of every risk. There's a very clear description of what credit risk is, what interest rate risk is. They haven't actually described what ESG risk is. They just talk about ESG risk management. Okay, back on the Prudential Code, Tina at Southampton. Does this relate to assets purchased for yield in recent years? This is about sort of the banning of borrowing to invest. So the question of how we dealing with newly purchased assets compared to historic ones. I mean, there'll be some assets that are generating yield. There are no records of when they were bought because they've been held in almost in perpetuity.
I think it's moving. It'll be from whenever the code is adopted, won't it? So, you know, you've got the consultation closes on the 12th of April. And is this the first of? Is there going to be two? Will there be a second consultation once people have responded to this with suggested changes?
Yeah, I think CIPFA planned. This is more of a principles-based consultation, and there'll be another one on the specific text of the code. So
we won't see this introduced probably until. Well, looking at CIPFA's previous track record, we'd look at April 2022 probably, if we're lucky.
Yeah.
So I think if anything moving, anything being done prior to, you know, maybe when hopefully they'll get it published before then, so that when you're preparing your indicators for the 22-23 year, you have regard to the revised code that's been introduced. But who knows?
Yeah, but yeah, I think obviously investment income from historic properties will still be in indicators, won't they? Because you don't separate that in your accounts. Yeah. It's likely to be.
Exactly.
And presumably that's based on the current use for the property, not the original use. So it might have been bought primarily for yield. If it's now used primarily for services, it's excluded.
Yeah.
Yes. Okay, I got one more question. Scroll back up. This is Ronnie from Edinburgh. Given the need for local authorities to support businesses post-COVID, isn't all this contrary to what central government's looking to do? I suppose there'd be a separation between activity that supports the local economy and activity that's purely investment.
And I think that's why they put that additional paragraph in about regeneration, so you can still, you know, regenerate your local area. But should you be buying assets that are a few hundred miles away from your local area, that's probably what they're trying to prevent, isn't it?
Yeah, they could say that if that's what they want to prevent, couldn't they?
They could do. They could make it easy, couldn't they?
Yeah.
Just say you can't do this.
Yeah.
But interpretation is what it's all about these days. You know, you've got freedoms, haven't you? And you've got guidance to follow, and there's always interpretation of that guidance. And if you act within what the regulators believe is the spirit of the guidance, then the guidance won't keep having to change. But if people keep trying to push the boundaries and finding ways to exploit the guidance or act in a sort of loose way, then that's why it has to keep being changed. We don't want to go back to the pre-prudential regime where it was clear what you could and couldn't do, and you had to ask permission from central government to borrow money. We want to continue in this way, really, but the code could be written in a slightly better way, I think. Yeah,
I think it's all very well to criticise local authorities for pushing the boundaries, but we need to know where the boundaries are.
Yeah.
Clear definitions of what is permitted within certain boundaries, and what is always not allowed. if there was maybe even a set of examples. I think that was something quite helpful in the PWB consultation, was they gave examples of what they thought was outside the scope, where the sort of close to the boundaries.
That's right. Yeah, they did.
Yeah. This wishy-washy line: authorities must not borrow more than or advance their needs, without any explanation of what their needs are. Can't really know if people interpret it differently, can you?
Absolutely. Yeah, absolutely right.
Brilliant. Okay. Thanks for your questions, everyone. So the consultations on the CIPFA website, on their consultations page, closing on the 12th of April. I think you and I will be having another chat, possibly late March or early April, just to go over our final conclusions. We'll circulate our consultation response to all our local authority clients. And we'll send it into the CIPFA course at the time.
We'll wait their responses to that.
Yeah, and hopefully we'll be able to sort of move on, understanding late summer, maybe see the new consultation in the autumn. Be good. So that just leaves me to advertise next week's Trending Treasury. Our colleague Greg Reddings, is one of our most experienced client directors, will be interviewing John Stopford from 91 Asset Management. That's a firm you may better know as Investec. They changed the name last year. And John's head of global multi-asset income. So we'll be talking about that as a strategy for keeping risk relatively low, but getting the best of the yield possible from the investment universe. So that should be an interesting talk. Thanks everyone. Good for you all to listen to us, and we'll see you next week.
Bye.